Time for some common sense from Craig Bolanos, the co-founder of VestGen and a wealth advisor, here to talk money. Hello, Craig. The dollar dropping this week. What's behind the dollar dive?
Angela, you and I talked all throughout last year about this concept of de-dollarization, and it's playing out in the headlines again today due to all the geopolitical posts on True Social, tweets, and what's happening out there. But de-dollarization is not about the dollar disappearing. It's about reduced dominance of the dollar over time.
The U.S. dollar has always been known as a dominant, safe place for Americans and people from other countries. But now investors, central banks, and foreign banks are buying up gold and silver as a safe place to store money as the dollar is going down. What does that mean for investors? Is it time to invest, though, in big multinational corporations such as a Coca-Cola that is overseas?
I encourage everybody to think globally. And why do I suggest that you think globally? Certainly, number one is when you're investing globally, a weaker dollar is going to magnify those foreign profits based on currency conversion for U.S. investors. I think another reason to think globally right now is part of de-risking or part of hedging your bets is to own other assets that are denominated in other currencies. I mean, just as you diversify across many stocks, there's nothing wrong with having some of your long-term retirement savings currency diversified as well.
Give us the rundown on some safe haven plays.
When things get tough, and I mean they really get tough, there is a movement of capital all around the globe into the strongest economies and the strongest currency. And I'm proud that the US dollar, even though it maybe isn't as dominant as it once was, we still maintain the pole position. But I encourage investors, when you're building those globally diversified multi-asset class portfolios, think about various forms of real assets. Angela, you and I have talked about real return investing. I think real return investing is going to matter more as we get deeper into 2026 and 2027. That leads you to asset classes like commodities, infrastructure, real estate, because those are things that tend to hold value more when fiat currencies slip. And let's not forget everyone's favorite precious metal, that being gold. I mean, gold isn't about speculation. Gold sometimes is like Tylenol. It's like having a little bit of insurance. So there's nothing wrong with adding a sliver of precious metals to a diversified portfolio as well.
And since we're talking about the dollar, what about holding some cash?
Well, I think cash is a viable asset class, but my version of cash is not cash that is non-interest bearing. Again, real return investing means making sure you actually have a real return after taking into consideration taxes and inflation. And that's why I think people should be seeking out various forms of short-term debt, whether those be liquid treasuries, short-term munis, other forms of asset-backed commercial paper. The days of getting 5% plus or 4% plus high-yield savings accounts is widely gone. So I encourage people to focus on cash as an asset class for upcoming expenses, but do your very, very best to control and protect your interest margins. If you want to learn more, you absolutely could and can connect with us online at getretiredstayretired.com. That's getretiredstayretired.com.